Chapter 8, Part 4, LIFO Reserve, LIFO Liquidation, and Dollar Value LIFO. Now what a LIFO reserve is when you set up a reserve for the difference between what you report outside versus what you report inside. And usually it's because for tax purposes you're using LIFO because you pay the least taxes, and for internal reporting you're using FIFO because it's going to give you the it's more indicative of how inventory flows. Now a company must set a reserve to reflect the difference between internal and external reporting. So let's walk through an example. So a company uses LIFO for external and FIFO for internal. At the beginning of the year, the LIFO reserve had a credit balance of $1.3 million. At December 31st, FIFO inventory balance was $2.9 million, but for external reporting and tax purposes, the balance was $1.5. Using LIFO, what should we do as a journal entry? So we start with our FIFO balance, subtract our LIFO balance, and it tells us that our difference is $1.4 million. We have $1.3 in the reserve, so what we're going to do is we're going to have to increase it by $100,000. So we're going to debit cost of goods sold and credit LIFO reserve. That's how you do LIFO reserve. Now LIFO liquidation, this is sometimes a strategy that companies use when they're trying to improve their bottom line at year end. So what they do is they deplete when they use LIFO, they deplete their inventory below normal levels so that they can get those low costs as part of cost of goods sold so their bottom line looks better. So in this example, we had beginning inventory 1,200 units, 12,000 units that we paid $6 for, probably a long time ago, and we purchased 8,000 units at $9. So we sold 12,000 units at $12 equals 144 in sales. So what is the effect of that? Well, we're going to have to take 8,000 at $9 because we're using LIFO. Most recent cost goes to cost of goods sold first, but we're going to have to deplete our inventory below its normal level of 12,000, and we add 24,000 to that, and we get cost of goods sold of 96,000. But what is the effects of LIFO liquidation on income? Well, net income without LIFO liquidation would have been 36,000. With LIFO liquidation, it's 48,000. So the effect is net income went up by $12,000 using LIFO liquidation. So this is something that they're looked for whenever there's an audit. Are they depleting inventory below its normal levels? Now, dollar value LIFO. What we're doing here is we're using indexing. So what I'm going to do is show you how I do it, and then we're going to take the same information and put it in the same format that your homework is in. So what we're going to do is, in our example, I don't have the indexes, and sometimes you get the indexes. So in this case, we're saying this is what the value was at year end. 2017 is called the base year, so it's always 1. And then we're looking at the future years, and we're trying to take it down to what is its value based on base costs. So first, if the indexes are not provided, they are not in this example, we have to calculate them. So we take the year-end value divided by ending year base cost. So in our case, 1 would be our first year, 2018 would be our second year, 2019, and so now we have our indexes which we need to determine the layers. Next thing we need to do is figure out what are the layers. Well, here's how I do it. Remember, the first year is always 1. So I take the current year price divided by the index, gives me the base year minus prior year base, and there is none, so first year is always the same. The current price and the base are always the same the first year. Now the next year, what I'm going to do is take that 441 divided by the 1.05, which is your index, gives you a base of 420. We subtract the prior years, which means we've got a layer of 20,000. For the next year, we divide by 112, and we subtract our 420 from our previous year, and now we have a layer of 15. And in our last year, we take our 510 divided by the 1.2. We have a base of 425 minus the prior year, which means we went down by 10,000. So now what we're going to determine are inventory values using dollar value LIFO. So for our first year, we're going to take 2017. That is going to be our ending inventory of 400,000. Now we have to start using our indexes on our layers only. Now we'll look at 2018. First, we would take the 400,000 times 1, and we take that $20,000 layer times the index for that year. And that gives us ending inventory at dollar value LIFO. Now let's do 2019. We're going to take 400,000 times the 1. We're going to take 20,000 times the 105 and we're going to take 15 at the 1.2, and this gives us 437,800 for our dollar value LIFO with the base cost of 435. Now we have a decrease for 2020. So we've got 400,000 times 1, we've got 20,000 times 1.05, and we've got 5,000 times 1.12, but because we had a decrease, we can never use the 1.2, and if we were to go to the next year, we could only use the balance of 10,000, which is the difference between the 15 and the 5, to index in future years. So remember, once the index goes away, you can't use it anymore. So in this case, we have ending inventory of 426,600. So because that minus 10,000, we have to take it away from the level above. Let me go back to that so you can see. So that's how it works. Now this is what it looks like if you do it similar to the way it is in Connect. You get the same answer, but I'm trying to show you what it looks like. Their inventory layers converted to base year, which is what I did. And I showed the indexes, and then I show the layers. Now let's look at one more problem. Okay, here we have the indexes, and now what we have is we have 5 years to walk through. So first what I'm going to do is go through and do my layers. So I had plus 16, but in this case I actually went down. And then I went back up, and then I went down. Because what I'm saying is in 2021, my inventory has a base value of 80,000. So let's see what the effect of that is. Remember, you're converting the current cost to base and then determining how much of the change should be indexed for the current year. All right, so for year 1, ending inventory is going to be 70,000 because that's the base year. Year 2, it's going to be 70,000 plus 16,000 at the 1.05. And so that gives us our $86,800 at dollar value LIFO. Now we'll do 2019. It went down by 4,000, which means there's only going to be 12,000 left at the 1.05 index, and we'll never use the 1.16 index because the inventory value went down. So now we can price our inventory. Remember, it's going to have to equal at base 82. And so there it's at 82.6 for 2019. Now let's do 2020. All right, now we went up by 6, so now we're going to figure out our ending inventory. We have only 12,000 at the 1.05 index, none at the 1.16, so we have to increase of 6,000 would be at the 1.2x index. So we take 2017 at 70 and 12 at 1.05 and 6 at 1.2. And that gives us a ending inventory at dollar value LIFO at $89,800. Now we have year 21. And we went down by 8. So with the decrease of 8, we're going to use none of the 1.25. We're going to eliminate the 2,000. Leaving 10,000 at 1.05. So that's gone away. That's gone away. So we're going to take 70,000 at 1, 10,000 at 1.05, and that's going to give us our inventory at dollar value LIFO in 2021. Now, well, let me go back and you take a look at that again. Now what I'm going to do, same problem using the format in your homework. So we go through, if you notice, we end up with the same numbers. We first, using the schedule, we put the inventory at year-end cost. We then put in our index, we convert it to base, and then we go through and do our layers for each year, and in the last column we show the inventory value using dollar value LIFO. So that ends this presentation, part 4, chapter 8.